Hello and welcome everybody. I'm Stephen and I'm a popular investor on eToro. Thanks very much for listening to my video today, and as usual, don't forget to like this video and subscribe to my channel. That will be amazing. Thank you. So in today's video, I'm going to be talking about what happened in the markets last week and how our portfolio did overall. And last week was a really good week and it was a great bounce back overall in the portfolio. And last week our portfolio was up about 5.5% last week, which showed a really tremendous bounce back. And if we compare that to the S&P 500, which was up about 6.5, and then the Nasdaq, which was up about 8.3, it was a very good week overall for our portfolio and for the markets. And I'm really pleased with that overall result. Although it slightly trailed the my benchmarks, I have a lot of diversification in my portfolio. So overall, it was a very good result. We saw really good results last week overall from crypto that had a generally quite a good week. We also saw a nice bounce back in some of our Chinese stocks, as well as some really strong gains from some of our technology and some of our US based stocks that did tremendously well last week. So we're on course and we're starting to make a comeback overall in our portfolio, and I'm very confident overall for the rest of 2022. Understand that there's been a lot of bumps along the way, especially in this first quarter of 2022. But I think as the year progresses and now there is a lot more clarity overall in the market, such as interest rates and the war in Ukraine and Russia seems to be easing slightly, and there seems to be some light at the end of the tunnel in terms of negotiations. I think that we have a good chance of delivering a very strong result in 2022. As we move on to the global weekly market update, and I'll start off with the US. And last week, as I mentioned, the US markets did extremely well, especially the technology sector, which outperformed overall. And there are several different reasons why the market performed really well last week, and they all went in the favor of the US indices. So one of them was to do with the Russia and Ukraine conflict, and there was talk from both parties that they are edging slightly closer to an agreement in terms of a ceasefire or stopping the invasion of Ukraine. Obviously, they're not there yet, and I still think it's going to take some time to agree some of the key points. But it's a step in the right direction, especially as they are talking, and the market viewed this favorably. Another area which I think saw the markets go up last week was in terms of the oil price. There has been a slight reduction in the oil price over the last couple of weeks, and last week was also no different. And this was overall seen a lot better in the markets as the energy costs hopefully look to decrease. Another point on Russia was that last week they made a sovereign debt payment, and there was a lot of concerns before that they may default because they left it up to the last minute. However, this calmed some of the worries as they did pay that sovereign debt payment. The last and probably the most important point on why the markets moved favorably last week was that last week was the March FOMC Federal Reserve meeting, and last week they decided to increase the interest rates by 0.25%, which was the first interest rate hike since 2018. And it marks kind of the end of the very loose monetary policy that we saw in place during the pandemic. And not only did they increase the interest rates by 0.25%, they also talked about a further 7 hikes for the remainder of the year. However, this was seen as kind of priced in already to the market because this is what had been expected already from analysts. So it was seen very favorably because I think what's worse than bad news or increasing interest rates is not having clarity, because what happens is you have a lot of people speculating about how many interest rate hikes there are going to be, and some of them about the state of the economy. So I think it's very important. It's good now that we have some clarity around the interest rate hikes. During that meeting as well, they also downgraded growth expectations from the year. Previously, in the last meeting, they had forecasted a growth rate of 4%, but however, that was downgraded to 2.8% for the year. And however, as this has been decreased, this is still quite a strong growth rate. And it's not something that we should be particularly worried about in the market. However, I think that this has been downgraded due to some of the speed bumps that have been in place, such as the Russia-Ukraine conflict and the rising price of oil and inflation. However, there was some data released from the US which said that retail sales in February had decreased from the month previously, which shows there is some slowing in growth in terms of the retail sector. The other point was that the producer purchasing index actually decelerated for the month of February, which is a good sign that some of those supply chain bottlenecks that we had in place are starting to subside slightly. There was also some discussions last week between President Biden of the US and President Xi of China, in which President Biden said to President Xi that he didn't want China to get involved at all in the Ukraine-Russia conflict, especially providing key weaponry in which the Russians have asked the Chinese to do. He also stated the repercussions of what would happen if China were to get involved in the Ukraine-Russia conflict. As we move on to Europe now, and last week the European indices generally did very well, and it was the second consecutive week overall of gains. And Germany performed particularly well last week, especially as they had been the most impacted originally by the Russia-Ukraine conflict in terms of Europe. Another key point which happened last week in Europe is that the UK announced another increase in their interest rates to 0.75% from 0.5%. And it is expected that there could be another 4 interest rate hikes before the end of the year. This is especially important because they are actually forecasting in the UK that inflation could reach 8% by the end of June, especially with those increases of oil prices since the last inflation readings. There was also a speech last week by Christine Lagarde, who is the head of the European Central Bank, in which she talked about how the Russia and Ukraine conflict could put inflationary pressures on Europe and could slow growth overall in Europe, which is quite normal, really, if we consider that the oil prices have gone up a lot since the last readings, and also commodity costs have increased quite significantly over the last couple of months. Another key area to consider as well is that Europe have decided to decrease the dependency on Russia in terms of oil and also in terms of gas. So there is going to be a transition period where they look at alternative energy and different places where they can export oil from in order to kind of slow some of those inflationary pressures down. As we move on to China now, and last week was a roller coaster week for Chinese market. And the week started off really badly, and we saw some significant declines in terms of Chinese and Hong Kong listed stocks. However, it improved during the week as there was a speech by the Chinese government in which they said that they plan to further support the markets as well as possible. and also ensure that more Chinese companies are listed in the US and that they provide good looser monetary policies in terms of supporting businesses overall in China. They also look to try and take away some of the uncertainty around ADR structures in the US. And this was seen as very positive overall for Chinese stocks listed in the US. And we saw some good rises last week, especially towards the end of the week in some of our stocks such as Alibaba and JD.com. Also, as I did mention in my video last week, I did expect the Chinese government to show support overall for the market. And they're also talking about peeling back or speeding up some of those tech regulations that they had put in place last year in order to help and grow the tech space in China and help the economy overall. And this was also seen as very good for Chinese tech stocks last week. Another key area in which the Chinese government said they are going to support, it was the ailing property sector overall in China. And there'd been lots of fears over the last couple of months that many of the largest property developers in China could default on their debt. So this was seen as a very positive sign. And China have also decided not to expand the property tax pilot that they had in place. I think that this was mainly put in place to stop the overheating of speculation in the property market. But as the property prices start to go down, then it's a good time for them now to stop that pilot and not put further pressure on their economy. We also saw retail sales increase for February, and we saw overall industrial production increase by 7.5%, which is really starting to show that some of those supply chain issues and some of those shortages that they had previously in terms of raw materials is starting to subside, and you're seeing really good overall industrial production in China. As we move on to the top 3 performing stocks of last week, and the top performing stock for last week was Square, which is also now known as Block, which was up 38% last week. And it will be unsurprising that the top stocks in the top 3 performing stocks of last week are all tech stocks. The second best performing stock of last week was JD.com. And that was up 36% for last week. JD.com again was another beneficiary of rises in the tech sector overall, but it also rose because some of those fears around ADRs being delisted in the US are starting to wane, and that had been heavily impacting the price of JD.com. The third best performing stock in our portfolio was another ADR, which is Alibaba. And that was up about 34% for last week. And it had a lot of the same tailwinds that drove the price of JD.com higher. So let's now talk about crypto. And last week was a good week overall for crypto. And we actually saw Bitcoin rise by about 8.5%. And over the weekend actually increased over 41,000, very close to the 42,000 mark. And also we saw even larger rises from Ethereum as it pressed towards reclaiming that $3,000 mark. As you all know, over the last couple of months, Bitcoin has kind of been ranging between the low of about 36,000 to a high of about 44,000 US dollars. And I think it's very important that Bitcoin breaks through that $44,000 range for us to see further upside. And I think another key area is the $46,000 mark, because this is the short-term average Bitcoin hodler price. And this is the average price which short-term holders have bought into Bitcoin. And I think if we can push past that with significant volume, then we are likely to see further upside. There may be a little bit of selling pressure around that 46,000, but as said, with enough volume, I think we can get through. We also saw last week a second consecutive Bitcoin hash rate adjustment. And I think a lot of this is happening because of those increased energy costs, and some people are shutting down their miners, which does make the difficulty easier for miners to be able to mine Bitcoin and actually makes existing miners more profitable. In addition to this, we also saw the Ukraine President Zelensky, who signed off the overall framework for crypto legalization in Ukraine. So again, that's another positive sign of a country which is embracing Bitcoin, and they've actually had a lot of crypto related donations to support the ongoing invasion from Russia. Last week, we also saw the release of the second batch of parachains on the Polkadot network. And some of these include Centrifuge as well as Efinity. Last week, we also saw the highly anticipated release of the Ape token, which is the token for the Bored Ape Yacht Club, which is a very large NFT collection. And when that was released late last week, we saw a slight drop off in the price when it was originally released. And then on the second day of trading, we saw a massive surge in not only volume, but in price as well. And this has since come down over the weekend and leading into Monday. I think that this is the type of token that you need to be extremely careful of. It's going to be very volatile. And you also need to know that many people who own the NFT collection got airdropped quite large amounts of ape tokens. So it's something I'd be careful about, because a lot of those holders could be selling those tokens in order to cash in on them. So it's not something that I would look to put into our portfolio. And if you are trading it, I'd be very careful. Thank you very much for listening to my video today. And lastly, I really want to thank you for your support over the last couple of months. I realize that it's been a very difficult and scary time overall in the market. But as we witnessed last week, when markets are suppressed for a long time, then you do get this strong bounce back. And it's very important that you're invested in the portfolio to be able to take advantage of this bounce back. And as one popular investor, 𝘃𝗶𝗱𝗲 once said, the markets are like a beach ball. And when you push the beach ball down against the water, and you push it under the water, then quite often it bounces back really strongly. And I think that with this new clarity in terms of the interest rate hikes, some of that fear around the Russia-Ukraine incidents are starting to subside slightly. I think that we are likely to have a very good second half of 2022. Also, don't forget to join my Discord group. We have a great community of people and we're constantly having lots of fun, as well as talking about interesting investing topics. So have a good week ahead.